Welcome to the Los Angeles Real Estate Roundup for May 20th, 2024. We have things to celebrate this week, namely an interest rate that starts with a 6 again. Mortgage News Daily is reporting that the 30-year fixed-rate mortgage, a national average based on surveys, dropped down to 6.99% on May 15th. Now, unfortunately, we've ticked back up to 7.09%, but I don't know about you, but I'm very excited to see a 6.99. In fact, this even has Logan Mohtashami, the lead analyst at HousingWire, asking the question, are mortgage rates about to fall? That's a very exciting question to ponder. We're going to get into the question, and I'm going to explain how mortgage rates work so that you can understand if mortgage rates are about to fall as more economic data comes out in the coming weeks. But first, we're going to cover this week's Los Angeles numbers. So behind me is Redfin's latest data for the Los Angeles Metro. Immediately behind me is the data presented in a year-over-year percentage chart, which I don't pay as much attention to because the last couple of years have been absolutely bonkers. So over my head is the part of the graph that I like to pay attention to, which is just the raw numbers represented in the lines going back to 2021. Right now, we're looking at the median sale price of a home in Los Angeles. At the top, this orange line represents this year, 2024. And as you can see, we backed off of last week's high price of $909,000 for a median home price in Los Angeles. We've backed off that, and now we're down at $903,000 for a median home in Los Angeles. This is good. I'm glad that we've backed off. Now, this $909,000 peak, it was actually $910,000 last week. I think Redfin revises some of their data as they go along. But last week, when it was $910, it was the equivalent of the peak pricing we had in 2022. And I was afraid that this was going to indicate just a horrible, record-breaking, eyes rolling into the back of your sockets price explosion this summer. Fortunately, we've backed off. But what's interesting is that last year, which is this blue line here, this blue line represents 2023. What's interesting is that last year, around the same time, we kind of had a pricing cool down before we picked back up and got to peak pricing in July. So do I think prices are going to fall for the rest of the year? No. Do I think we're going to have a weak summer? Not even. We've fallen off a bit this week, but I do think we're going to continue to see price climbs to its natural peak in June and July. New listings are still higher than last year, but they've fallen off a bit, both in actual numbers and as a year-over-year percentage. So last week we had 1,516 new listings, which was 15% higher than this time last year. This week we have 1,499 new listings, which is 14.7% higher than last year. So obviously, in order to keep the market healthy, because we're so inventory constrained right now, we want to see new listings continue at least apace with where we were last year. And we roughly are, but this week was slightly lower than the week before. Active listings is tracking very well. This week we are 8.51% over the year before. Last week we were 8.54% over the year before. Statistically, that's the equivalent. So active listings are keeping up in their gains from last year, which is great for the market. Price drops saw a little uptick from 3.8% of active inventory to 4% of active inventory. Is that the sign that the market's beginning to weaken just a little bit? Well, at the same time, we also saw the percentage of homes that are off market in 2 weeks tick up from 36.6% of homes that hit the market to 37.3% of homes that hit the market. These statistics obviously are running a little bit counter to each other. One is suggesting the market cooled a bit this week. The other is suggesting the market warmed up a bit this week. For a metric that really sums it all together, let's look at weeks of supply of inventory, which ticked up this week from 12.5 weeks to 12.9 weeks. I like weeks supply of inventory. It's one of my favorite metrics because it wraps everything together into one number. It wraps together supply and how much supply is coming to the market, as well as demand and how much supply demand is taking off the market. And when weeks of supply grows, that means that supply has outweighed demand just a little bit this past week, which is great. We want to see inventory grow. We want to see supply begin to pick up on demand so that we reach a more balanced market. And what's also interesting, when you look into this chart, and I'm going to take 2022 off the chart because 2022 was a very weird year. That's the year that rates doubled and things went wonky. But if we look at 2023 and 2021, we see that this period, this kind of spring into summer, is a period of time when weeks of supply decreases. So it's actually kind of unusual that for the past month, we've had a general uptick in weeks of supply in the LA market. To me, this is a more telling metric than the other metrics we've looked at. It suggests that maybe this summer actually will be less inventory constrained than previous summers, and we perhaps won't have as high a pricing peak as we had relative to previous summers. So this is definitely the metric that I'm going to be keeping my eye on in the weeks to follow. Be sure to subscribe and hit the bell so that you can keep your eye on it with me. All right, let's get back to the big deal with mortgage rates. So again, Logan Motoshami, whom I love, he's a lead analyst at Housing Wire, asks the question, are mortgage rates about to fall? And to answer that question, let's talk for a second about how mortgage rates work. All right, I'm very tiny. This graph is very big. I hope it's helpful. At the top of the graph, this red line is the 30-year mortgage rate over the past 12 months. We kind of climbed toward the end of last year. Then we had a nice fall off early this year. Since then, we've sort of been on a slow climb with a big uptick just this past month, and then a nice little decline of like half a point in just the past 2 to 3 weeks. Below the red line, the orange line is the Fed rate. It was at 5.25% until a July hike, and then it's been at 5.5%. Now, if mortgage rates are tied to the Fed rate, why has the mortgage rate moved so much up and up and down, up and down, up and down, when the Fed rate has remained perfectly flat? Well, to answer that question, we go to the blue line at the bottom. This blue line is the 10-year Treasury yield. Okay, so what's the 10-year Treasury yield? So the Treasury issues securities. Those are like IOUs, and big institutional investors give the government money to fund what the government does, and in exchange, they get these securities, these IOUs. One of them is the 10-year Treasury security. And it's basically an IOU that says, I'll pay you a certain interest rate for 10 years, and at the end of 10 years, I'll give you back all the money that you gave me. Now, Treasury securities are auctioned off, so they don't have a set rate of interest. Like when you open a bank account at Ally, for example, where I have a bank account, right now they're paying something like 4.3% interest. They tell you what it is. When these big institutional investors go to buy treasuries, the interest rate isn't set in stone. Instead, it's an auction. So basically, the more people who want to buy treasuries, the lower the rate the government has to offer to sell all their treasuries. And the fewer people, the fewer institutional investors who want to buy treasuries, the higher the government has to raise the rate they're offering in order to attract enough buyers to sell off all their securities. So this blue line here represents the appetite of the institutional investor market in buying treasuries from the United States government over the past 12 months. And as we can see, towards the end of last year, that rate went up, meaning fewer institutional investors, relatively fewer institutional investors wanted to buy 10-year securities. Then the rate went down, meaning that more institutional investors wanted to get in on the action of the 10-year securities. Then the rate climbed back up, and then more recently, the rate has fallen back down. So the way I've described the 10-year Treasury yield is exactly how I described 30-year mortgage rates. As you can see, let me get rid of my doodles. As you can see, these two lines look almost exactly the same. So while mortgage rates are connected to the Fed rate, they're not tied to the Fed rate. Really, they're tied to the 10-year Treasury yield. And what's crazy is that the 10-year Treasury yield is determined by, get this, sentiment. That's right. I dropped the term institutional investors, which basically means giant banks and countries and other, large entities that have a lot of money to invest. But ultimately, it comes down to a couple of guys and gals looking at the U.S. economy and deciding, do we want to buy more U.S. treasuries or not? And generally, when the economic outlook for the United States is really, really strong, institutional investors are less interested in treasury securities and more interested in investing in the private market. The private market is riskier than treasury securities, but if the economy is booming, it becomes relatively less risky because everything is going up, and institutional investors want to invest privately more than in the U.S. government. Conversely, when the economy kind of starts to slow down, there's a flock to U.S. treasuries. U.S. treasuries are the most secure investment in the world. So when things start to get rocky, investors want to come in. So what determines the relative up and down of this line is just how investors feel about the U.S. and to an extent the global economy. Again, it's sentiment. So does sentiment determine mortgage rates? Well, yes, but it's not as simple as that. It's actually, you might say, compounded sentiment. It's two layers of sentiment because the distance between the 30-year fixed rate mortgage rate and the 10-year Treasury yield is something we call the spread. So what is the spread? Well, the spread is what accounts for the added risk of investing in U.S. mortgages over investing in U.S. treasuries. So investing in U.S. treasuries, like I said, is generally the safest investment in America. Some people call this blue line the riskless rate because it's the rate that an institutional investor can earn on its capital with relatively no risk. Now, investing in 30-year fixed-rate mortgages in the United States is a extremely risk-less investment, but it's not risk-free. Investing in 30-year mortgages in the U.S. is a little riskier than investing in U.S. Treasuries. And the way that institutional investors account for that is with this spread. So, toward the end of 2023, you could invest in a Treasury and earn a yield of 4.88%. And around the same time, you could invest in 30-year mortgages and earn a yield of 7.79%. So that's a spread of about 3%. So what determines mortgage rates is sentiment along two lines. One, how's the economy doing? So how does that dictate as an institutional investor, how does that dictate my appetite for U.S. Treasuries? And then how's the mortgage market doing relative to that? And that determines the spread. Okay, if you're still with me, we're about to wrap this all up. Returning to Logan's story, he presents this excellent graph showing the spread, specifically the spread between 30-year mortgage rates and the 10-year Treasury securities yield. Now, as you can see, at the beginning of 2022, before rates doubled, we had a spread of 1.577%. And while rates were doubling, the spread rose all the way to 2.99%. So the spread almost doubled, while rates also almost doubled. Why? Well, rates doubled as a function of the Fed raising the Fed rate for fears that the economy was overheating. With the economy being so hot, fewer institutional investors wanted to buy 10-year securities, so that forced the rate up in order for the government to be able to sell all their securities. Now, what's crazy is the spread also rose at the same time because at the same time, the same institutional investors who buy packaged 30-year mortgages were concerned about what was happening in the mortgage market. There was a fear amongst investors that as soon as rates came down again, borrowers would refinance. So investors were worried about buying these 30-year mortgages because they were afraid that the 30-year mortgage would get refinanced a year later and the investor would get their principal back but would stop earning interest. So to account for this risk, this risk that they would stop earning that interest sooner, investors increased the spread. Now, what's happened since the end of 2022 when the spread reached nearly 3%? Well, in 2023, which is the red line here, the spread stayed basically flat from years beginning to year end, from 2.71% at the beginning of 2023 to 2.75% at the end of 2023. However, in 2024, we've actually seen some spread decline. The spread started the year at 2.69%, then climbed to 2.73%, and is now down at 2.6%. And there's a feeling amongst people who track this, like Logan Mohtashami, that as rates drop, the spread will also drop, creating a double whammy effect for mortgage rates. So for example, if the 10-year Treasury yield drops like half a point, that's going to be great. That means mortgage rates drop half a point. At the same time, investors in mortgages might think, with rates lower, there's a lower chance that these current borrowers are going to refinance in a year. So I need to price in less risk to the spread. So maybe the spread also drops half a point. Do you see that? It's like a domino effect. The yield drops half a point, and that also pulls the spread down with it. And between the two, you get an entire full point drop in 30-year mortgage rates. Could that happen? The answer, according to Logan, and perhaps this is according to me, is yes, because the economy is beginning to cool down. And as the economy cools down, more institutional investors are drawn to government securities, pushing that rate down. And where we see the best evidence of the economy beginning to cool is in the labor market. In a story from earlier this month, also by Logan Mohtashami at Housing Wire, Logan says, labor market report is good news for mortgage rates because the labor market is beginning to cool, which is going to pull, and we're already seeing it, is pulling mortgage rates down. And there's 3 graphs in this article I want to share with you that perfectly demonstrate what's going on. First, this graph shows job offers in the U.S. And as you can see, we are back in line with the historical trend since the economy last bottomed out during the Great Recession. The second graph shows the U.S. quits rate. Now, the quits rate is the percentage of employed people who are quitting. And when the quits rate is very high, workers feel a huge amount of job security. They're comfortable quitting their job because they know they can get a new job because there are so many employers hiring. Well, right now, the quits rate is around 2.1%, which is right around where we were pre-pandemic. In other words, the quits rate is back to normal. We're back to a pre-pandemic vibe out there in terms of job security. And finally, we have this chart showing the total number of employees in America. And as you can see, it has a very steady growth because of the fact that the United States is just slowly growing in population. And finally, after this incredible growth during the pandemic, which, followed this, huge laying off of like a third of the country, we are now finally back to our long-term norms. So the feeling is that the job market is slowing, not because the economy is going into recession, but because we're getting back to where we used to be, to our long-term average. And that's really, really good news for everyone involved. Institutional investors see that the economy is cooling, so they'll go back to buying securities, which will pull down the rate of the 10-year yield, which will also lower the spread, which will bring down mortgage rates for home buyers. With lower rates, we'll also see more home sellers coming to market, because after all, almost all home sellers become home buyers. There's been a lot of talk over these years since the pandemic as to whether or not the Fed is going to be able to pull off a smooth landing. The jury's still out. It seemed like late last year, maybe mid last year, there was this vibe like, oh my goodness, the smooth landing is happening. And then we ran into some turbulence this year. Well, looking at a chart like this, to me suggests that the landing is going smoother than we could have hoped for. And that's good news for all of us. If you want to stay informed what's happening in the housing market, especially right here in Los Angeles, subscribe and hit that bell icon so you get notified when the next weekly roundup drops.